Securing a personal line of credit with bad credit and no bank account. A strategic overview. 1. Understanding the nature of a personal line of credit. A personal line of credit, PLOC, is a revolving financial product that differs from both traditional loans and credit cards. It allows a borrower to access funds up to a predetermined limit on a recurring basis, contingent upon repayment. Unlike an installment loan that delivers a lump sum up front, a PLOC provides flexible access to capital, with interest accruing only on the amount withdrawn. The cyclical nature of the credit replenishment makes it a versatile financial tool for borrowers who can demonstrate consistent repayment capacity. Footnote: this section outlines the fundamental differences between revolving credit and installment-based credit products. 2. Implications of lacking a bank account. While most financial institutions require a bank account for fund disbursement, alternative solutions exist. Some lenders permit borrowers to open proprietary accounts, while others transfer funds to reloadable prepaid debit cards. The absence of a bank account introduces logistical hurdles, but does not eliminate the possibility of obtaining credit. Prospective borrowers must instead demonstrate a secure and verifiable mechanism for receiving and managing funds. Footnote: this section explains workarounds for applicants without traditional banking access. 3. Determining the most suitable type of credit line. It is critical for borrowers to assess whether a personal line of credit is optimal for their situation. Alternatives such as a home equity line of credit, HELOC, or business line of credit may offer superior terms, particularly for homeowners or entrepreneurs. Each credit instrument entails unique eligibility and risk parameters, and alignment with the borrower's asset profile or business structure may result in higher approval odds and lower rates. Footnote: this section encourages critical evaluation of alternative credit options based on individual financial circumstances. 4. Lender risk assessment and creditworthiness factors. Lenders perform multidimensional risk assessments, focusing not only on credit scores but also on income streams, credit history, and the borrower's rationale for past delinquencies. A bankruptcy may be deemed more severe than missed payments. Demonstrating a stable source of income and a plan for fund utilization enhances the applicant's credibility, even with a low FICO score. Risk mitigation is the lender's principal concern. Footnote: this section reveals how lenders weigh different risk factors in evaluating applicants with poor credit. 5. Minimum requirements and the role of alternative lenders. Most traditional financial institutions impose stringent requirements. However, online and alternative lenders often cater to high-risk borrowers. These entities typically impose baseline criteria, such as a minimum monthly income or credit score, and may offer soft credit inquiries during pre-qualification to preserve the applicant's score. Understanding and meeting these minimum thresholds significantly increases approval potential. Footnote: this section explains the eligibility criteria used by alternative lenders to evaluate high-risk borrowers. 6. Strategic shopping and timing considerations. Applicants are advised to survey multiple lenders and apply when their financial metrics, such as income level or credit score, are at their strongest. Strategic timing can also coincide with promotional lending periods offering reduced APRs. Using pre-qualification tools minimizes risk and informs the applicant of likely outcomes without harming their credit profile. Footnote: this section outlines timing and comparison strategies to maximize the likelihood of credit approval. 7. Accessing funds without a traditional bank account. Lenders may facilitate fund access via prepaid debit cards or accounts opened through their own platforms. Applicants flagged by check systems or early warning services should anticipate these limitations and propose viable alternatives for fund disbursement. The method of access must be clearly communicated and verifiable. Footnote: this section describes practical methods for receiving credit line disbursements without a bank account. 8. Responsible use and building a credible repayment history. Upon approval, proper utilization of the credit line is paramount. Responsible drawdown behavior and on-time repayment signal financial reliability to the lender and improve future lending prospects. Without a traditional banking relationship, the borrower's usage pattern serves as a proxy for financial discipline and risk. Footnote: this section emphasizes the importance of responsible credit usage and repayment to establish trust with lenders. 9. Documenting expenditures and establishing reputation. In lieu of a bank account, borrowers must maintain meticulous documentation of how funds are utilized, whether for home improvement, emergencies, or income-generating ventures. Transparency in spending reinforces borrower credibility and supports future loan applications, where historical usage and repayment behavior may outweigh FICO scores. Footnote: this section underscores the need for record-keeping in the absence of bank-verified transaction histories. 10. Conclusion: a framework for approval. Securing a personal line of credit with bad credit and no bank account is feasible, but demands strategic planning. Key success factors include selecting the correct credit product, meeting basic lender criteria, shopping intelligently, applying at optimal times, and building a responsible usage history. These practices collectively enhance approval odds and facilitate better financial outcomes. Footnote: this section provides a synthesis of the procedural and strategic steps necessary to secure a personal line of credit under challenging conditions.